Welcome to the Allan Small Financial Show. I want to thank all of you once again for taking the time out of your busy day and spending it with us. We have another fantastic show for you this afternoon. We have another great guest. Trevor Toome is a professor of economics at the University of Calgary, Department of Economics, and Director of Fiscal and Economic Policy. He's going to talk to us about the economy, and perhaps more importantly, he wrote a paper recently about barriers, breaking down barriers. And these barriers are interprovincial barriers. I found it fascinating when I caught up with Trevor this past week when he spoke to me about how just taking down those interprovincial barriers, how much more growth we could see in our overall economy here in Canada. It was fascinating, and I think all of you will find it very interesting as well. So we have Trevor on our show this afternoon. We also have a number of other topics of our show, and we can put those up. There you go. We're going to start off by talking about keeping the recent pullback in perspective. I've had a number of calls from individual investors of mine, investors that invest elsewhere, that want some advice, getting lots of calls on the recent pullback in the markets, which started somewhere around, let's say, mid-February. And it's been really choppy ever since. So we're going on maybe 5 weeks of choppiness, making people a lot very nervous. So we're going to show you, or I'm going to show you some statistics shortly that keeps that downturn in perspective and why I'm not as nervous as perhaps some of you are. We're going to tackle Canada's internal trade barriers. And this is the interview with Trevor Toome, interview with Calgary economist Trevor Toome. And as I said, it's going to be quite enlightening. He's going to talk to us about these barriers, about tariffs, and about the economy. So definitely a don't miss interview there. As always, top 3 things to consider before you make your investment decisions over the next 5 to 10 business days. A very big part of our show, a part that I know many that talk to me after the show, they love to see this part of the show. They find it quite interesting and helpful. So we will continue to have that segment in our show for shows to come. Bank of Canada recently made a 1/4 point rate cut. Why that's important, even in the face of higher inflation, which we just received some data that shows that inflation spiked a lot higher than what was anticipated by the Bank of Canada. Is the market more concerned about a recession in the US or inflation in the US? Interesting question. I think once upon a time, inflation was the number one issue for the Fed. Now, perhaps recession may have taken over. We're seeing a slowdown in the economy in the US, and I think a lot of investors are now a lot more fearful about a recession, especially due to the tariff wars that are being waged with the current administration, President Trump putting tariffs on many things and about to put tariffs on even more countries come the beginning of April. Big cap tech stocks are hit hard. We've seen big cap tech, the NASDAQ in particular, hit hard over the last 5 weeks. Stocks have been coming down. The NASDAQ has been the hardest hit, down about 13% from the recent high at around end of January. And that actually means it's in correction territory. Although we have seen tech stocks rebound a little bit in the last few days, maybe week or so. So we'll see maybe the charts will show a bit of a spike up. But make no mistake, tech stocks, some of them down 15, 20% from their high points. Quick hits, these are 3 ideas that you've seen in the news recently. I'll comment on those. And last but definitely not least, your questions. If you have any questions during the course of the show regarding the interview or anything you could think of regarding markets, economy, particular investment ideas that you want to ask me about, please put them in the chat box. Love to answer them on this show or perhaps on our next show in 2 weeks' time. So without further ado, let's move forward with our show. I think it's really important to keep the recent pullback in the markets in perspective. As I said off the top of the show, I've received a lot of calls, a lot of nervous investors. Some investors telling me, we have never seen something like this before where the market has fallen for this long or this sharply. I heard some investors wanting to sell out of the market and move into some fixed income, more fixed income, or sell completely out of the market and just wait on the sidelines for better days ahead. And as I always say on this show, I'm not a fan of that approach. I'm not a fan of that type of management. You can never time markets. By the time you figure out the coast is clear, if you get back into the market, you probably would miss out on a significant amount of gains, whether it's 20%, 25%. These gains happen very quickly. And we all know that if you miss the best, 10 or so days in the market over a period of time, your returns are significantly reduced over that period. And so, for you to make and to outperform, make money and outperform over the long term, you need to be in this market for those good days. And because we don't know when those big up days happen, unfortunately, you're going to have to be in there for the bad times as well. And what we do know is some of the biggest rises or surges in the market tend to happen right after the market declines. So very difficult to time markets, and definitely not a strategy I would recommend or use. We're going to show you some charts right now, and these charts will clearly show you that the decline that we had this year, now I mean this year from Jan 1 to present day, of roughly about 5% on the S&P, TSX, Toronto Stock Exchange, roughly flat on the year. And then you have the NASDAQ down a little bit more, in and around, let's call it, 7, 8% on the year. So a little bit more, not as bad as seeing a 10% decline from the highs or 13% declines from the NASDAQ from the highs. And I think individual investors get confused when we talk about declines for the year and declines from the all-time high. Perhaps the all-time high was too high to begin with. Maybe the market should never have gotten that high. And so they're giving back a little bit of the gains right now. And I think that is the case. And I am confident that we're going to see these markets surge higher down the road. So our first chart shows you the S&P 500. It's going to show you how the market has fared on the right-hand side since about mid-February to present day. You can see a bit of a blip up on the right-hand side. That's the S&P 500. And that will show you that the market's down coming into today. I know the market's higher today, in and around 5%, give or take a little bit. Our next chart here will show you basically a 1-year chart. And you can see here, and we're going to magnify the certain points in the last year. But if you look at the April time period, you will notice that there was a decline last year, a pretty big one, 4% decline in April of 2024. So even though we saw gains of 20+% on the S&P, we had declines in April of 4%, so negative 4%. If you fast forward to August, which is the next blip down there, you will see that in August, we actually lost 6%, a 6% decline in the first few days of trading. So the first week of trading, the market dropped 6%. Putting that in perspective, in the last, let's call it 5 weeks, the S&P 500 has lost 5%. So which is worse? Well, I think the decline last August was definitely worse. Much more sharp, quick, sharp decline, which is somewhat what we're seeing now. But look at what happened after that. The market continued to roll higher, and we ended off making over 20% return. Our next chart actually is a great illustration of comparing what's going on this year. So on the far right-hand side, that is the decline this year from about February to where we are today, third week of March or so. But if you go all the way to the left, that is the decline that we saw in August. The decline of the line down is much more steep versus slightly less steep in the March. And then you could also see there was a decline in September. We saw one. In November, we saw one, which were definitely not as steep as August or the one we're experiencing now. So even in a good year, we do see declines in the market. Usually you see 1 or 2 declines. And as I say often on our show, over a 5-year period, you see 1 correction or so. Over a 10-year period, you might have 2 or 3 years of negative markets. But on average, you're going to see about 7 or 8 positive years. Our next chart here, the S&P 500, this magnifies or shows us kind of a zoomed out or zoomed in, I should say, perspective on April of last year. You can see the fall towards the left side before we got to May, and then May was a fantastic month. And our next chart here, which is our last chart for this segment, and it zooms in on the August decline, our last S&P chart there. You'll see there it is, the August decline. You can see just in the first few days, a pretty sharp decline on the far left of that chart. So what does this show us? Well, ultimately, as investors, you can never really get too high, you can never really get too low. You got to stay even keel. You want to take emotion out of the markets as best as you can. And unfortunately, with what's been going on with respect to tariffs, trade wars, interest rates, inflation, President Trump and what he's been saying and how he's been talking about Canada as the 51st state and all of that, I think it's really stirred up a lot of emotion from Canadians, from investors on both sides of the border. A lot of people are unhappy with what has been said and how things have worked out so far. But you can't let that affect what you do with your investments. You can't let that affect your portfolio and what your ideas are, and to continue to look for good quality even in difficult markets. So, as I've shown, even in a downturn as we're experiencing now, it is not the first one. It is not one that we haven't seen before. We actually saw downturns last year that were worse in a very short period of time, like we saw in August. So 5% decline in the markets, I don't want to say is expected because we never like to expect it, but it definitely happens. And going forward, I think you should expect more corrections in the market. Hopefully, we get a bit of a bounce back here, maybe come April, which historically is a good month in the markets. We're also going to get perhaps some certainty on some tariffs, reciprocal tariffs that perhaps will be announced at the beginning of April, which, yes, may not be that positive, but at least it'll give us some certainty. And as we know, markets like certainty. So I look forward to, as I said off the top or the start of the year, a positive year. I think we just got to get through these difficult times to get to the other side before we experience a year that I think will still be in and around 8 to 10% growth on the S&P 500. Welcome, Trevor Toome, a professor of economics at the University of Calgary's Department of Economics and director of fiscal and economic policy. Trevor just published a paper last month entitled Breaking Barriers: How Provinces Can Drive Canada's Prosperity by Unlocking Trade and Labor Mobility. And he was a co-author of a well-respected Macdonald-Laurier Institute study on Canadian internal trade barriers called Liberalizing Internal Trade Through Mutual Recognition: A Legal and Economic Analysis. I'd like to welcome to the show, Trevor Toome. Hi, Trevor. Thanks for being with us.
Great to be here. Thanks for having me on.
My pleasure. And I guess what perfect timing, right? With everything that's going on with respect to tariffs in the United States and even the markets, the economy, all the different numbers we've been seeing, unfortunately, to the downside in what we're predicting going forward for GDP growth, et cetera. So I thought, we would talk or start off with talking about these trade barriers, barriers between provinces, and get a lot of questions on this. I have a lot of questions myself, but I figured I would start with asking the question, how would reducing Canada's internal trade barriers offset the negative effects of the tariffs? Would it be a big offset? We've seen some numbers, but I know a lot of people are starting to question those numbers. So in your opinion, would it be a large offset?
Yeah, I think it would be a large offset, and that's why it's entirely appropriate that we're seeing governments put a lot more attention onto this issue than they have in the past. So, to understand why the economic implications of this are so large, it's first important to appreciate what internal trade barriers are. We don't levy tariffs or have quotas or those sorts of border controls that we do on internal flows like we do between countries. Instead, internal frictions result from differences in rules and regulations and standards and certifications and so on that each province is responsible for in most areas of economic activity in Canada. And when the rules of the game are different from one place to another, that adds costs to any business that's operating across provincial boundaries, whether selling or buying or having multiple plants or facilities in different locations. And so thinking about internal liberalization, it's best intuitively to think about it as a kind of red tape reduction initiative where we're not literally cutting regulations, but we're harmonizing them or recognizing as valid each other's rules and regulations to ease the ability of businesses to operate or ease the opportunities for workers to move. And the gains come in a couple of forms. First, if you're a productive firm and it's easier to operate across Canada, well, now you can grow larger, hire more employees, invest more in your facility, in your equipment. And as you grow larger, you tend to get more efficient. It's also going to allow different provinces to specialize in the things that they're particularly good at, just like international trade. And the gains that we get from internal liberalization are therefore quite similar. And the gains, I wouldn't say they're implausibly large. My own estimates in that McDonald-Laurier Institute paper in 2022 that is co-authored with Ryan Minuch, we published and we estimate the gains are potentially between 4 to 8% of GDP. And that does tend to be larger than the estimates out there from myself, from the Bank of Canada, various financial institutions around the cost of what a 25% tariff might mean. So long-term gains from getting our internal market um, more harmonized is potentially larger than the costs of these tariffs with the United States.
Yeah, and that's I didn't realize the numbers could be that high. I was thinking, well, we're hearing that GDP could take a hit of about 3-4% from these tariffs. And if you're
Yep.
talking, 4 to 8, 6 to 8 from bringing down these barriers between provinces, that's fantastic. I was hearing
Yeah.
more a number closer to 3-4, but do you think any industries would benefit, any specific industries would benefit from taking down these barriers?
Yeah, most of the benefits internally come from service sectors. So we think about trade with Canada and the United States, it's mostly goods. About 80% of what we sell to the US is goods, merchandise, 20% services. But within Canada, a majority of interprovincial flows are services. And where regulatory barriers hit the hardest are when professional credentials require provincial licenses. There's hundreds of occupations where provincial specific licensing binds. And that means that you might be facing barriers to taking on a client in another province if you're not appropriately registered there. Plus, labor mobility is inhibited from these sorts of issues. And so within services, that's where most of the gains are. And for the most part, it's services like professional and scientific services, financial services, those that are suppliers of critical inputs into businesses and their operations, rather than providers of final services to individuals.
Right. Any of the data you've looked at on this topic, obviously, does it get into any foreign investment? Like, do you think bringing down these barriers between provinces would spur on foreign investment into our country?
So that's an important channel here. We have a lot of foreign investment in Canada, and we always have. We're a smaller economy, and so we often look to external sources of capital to scale up businesses. But if you're a foreign investor thinking about setting up a facility in one province, you also face costs of setting up another facility in a different province because now you have to learn and comply with a different set of rules and regulations. Or your facility that you're investing in one province, say British Columbia, it might not be as large as it could be because its ability to sell into other markets within Canada is also inhibited. And your purchases of inputs from other provinces is also going to face additional costs. So easing internal trade barriers means that it's going to be more efficient for you to have a facility in Canada, and that facility can be larger than it otherwise could be. And you might be able to set up other facilities more easily in other parts of the country. So it does lower the cost of investing in general, including foreign investors.
And yeah, and I guess, talking to the premier as often as we've had him on our show a few times and talking about bringing a lot of business to Southern Ontario in particular, Premier Doug Ford, that is.
Mhm.
And obviously anything we can do to help bring foreign business into Ontario, to Alberta, BC, whatever the province is, our country in general, I'm obviously would be a large help. And again, something we can do within our borders. We don't have to rely on the United States to do something or other trading partners. So that's a pretty good I guess silver lining or positive for us. Turning now to maybe the Bank of Canada or the federal government, in your opinion, what do you think they can be doing? Maybe what they could be doing more of to perhaps mitigate the effects of these tariffs that have already been put on Canada, and we're hearing, about the tariffs that could come down the road. Is there something that you would say the Bank of Canada and our federal government, I guess, our newly appointed leader of federal government, can be doing going forward?
Yeah, two things. I think for the Bank of Canada, it is critically important that we remember that they are and ought to be singularly focused on inflation. That is a difficult job, maintaining a 2% inflation. We weren't able over the past couple of years to maintain that target, but that is the goal, and that is the only goal for the Bank of Canada. So they should raise interest rates or lower interest rates or use other tools as they determine in order just to meet that 2%. And no other objective should matter at all, full stop. They're not there to concern themselves with unemployment or income distribution or investment certainty. It's just inflation, full stop. Now, the rest of the federal government, the elected representatives through largely fiscal policy or regulatory policies, I think how we respond should, be smart about the problem here. The tariffs that the United States are levying, it's hard to know what's motivating them, but there's not a lot that we can do about that beyond diplomatic engagement to the extent that we can. Our retaliation options are incredibly limited. A small country's opportunity to cause economic damage in a larger economy through tariffs, or in Ontario's case, electricity export taxes. I mean, these are tools that might have value in a non-economic sense, maybe facilitating a public relations campaign in the United States, but they're not going to move the needle on the US economy. And so the response that governments here, whether it's federal, provincial, or even local, ought to just be on what are the measures that we can do to increase Canada's competitiveness, increase our resilience, increase how much investment we can attract. How do we increase our productivity despite the tariffs? And that means easing regulatory burdens. Maybe it means tax reform. It certainly means mitigating internal trade frictions. Maybe it means infrastructure investment, but that's where the focus should be. What are the levers that we can pull to boost growth, boost productivity, and then leave the diplomatic engagement to Global Affairs Canada, and that's tough work. But on economic policy, we should be continually asking ourselves, how do we improve the Canadian economy through domestic policy improvements? And there's a lot of low-hanging fruit because Canada's economy has been stagnating for many years, and there's a lot of things that hasn't been going very well.
Right, right. And you bring up a great point. A lot of people talk about all the back and forth between, the premiers and the prime minister, Prime Minister Trudeau. And, I know some people have said, are they poking the bear, right? With respect to the conversations they've had with President Trump, and, the back and forth, obviously very emotional. You have your, yeah, brothers to the south, and all of a sudden
Yeah.
we feel they're turning on us, right? With what's happening. And no wonder, investors feel nervous. I've been getting a number of calls, a number of messages over the last month, maybe even more now, about what's going on. What do I see going forward with respect to the Canadian economy, stock market? Is this going to last a long time? Is this environment going to last a long time? So I thought I'd pose the question to you. Where do you see the Canadian economy going this year? Do you think we will get past this, I guess, the first half of this year, and we will see better things in the second half? I guess when we ring the bell, December 31st, when that I guess the big ball comes down in Times Square on December 31st, where do you think the economy is gonna end up? Where do you think the Canadian economy? How do you think we're gonna fare? I guess for the last, I guess, 9.5 or so months of this year.
Given how much uncertainty there is, it's difficult to know where we're going to be in 9.5 hours or 9.5 days, let alone 9.5 months. So I certainly won't offer a prediction about where I think we actually will end up being at the end of the year. I think it might be best to think about scenarios. If the tariffs come in and stay, and they are broad of the order that's been communicated, 25% on almost everything and 10% on some energy and resource goods, that would potentially slow economic growth by, estimates vary, but somewhere between 2 to 4%. My own estimate's closer to 3. Bank of Canada's estimates are about 2.5 in that first year. So potentially enough to push Canada into recession in 2025. Add to those tariffs, the high uncertainty alone will be a drag on investment and will increase unemployment. The amount of uncertainty that we've been measuring is up so much that if historical patterns hold, we might see declines in investment over the coming year on the order of about 25% unless things improve quickly. And unemployment rates rising just from uncertainty alone, something on the order of about 1%. Again, if things continue as they are for the rest of the year. And so that plus the tariffs might mean that unemployment nationally rises to close to and around 10%. And that'd be a very difficult time in the labor market. That right there alone is roughly 600,000 jobs lost. But if the tariff uncertainty can be resolved, federal policy uncertainty also may be soon resolved, depending on election timing and what's decided there. Then uncertainty could fall, the trading relationship might look more secure, and things could improve relative to that pessimistic scenario. I think even in the optimistic scenario, there's no avoiding slower growth. Like, do we have real GDP growth in the order of 1 or 2%? Or is it negative? That's kind of the range that I think we're looking at. Unemployment rate has also been rising recently. And the last labor force survey data that we saw may be an early indication that the labor market is going to start getting weaker, kind of plateauing there in February. So I think we may very well see unemployment rising a little more through this year, largely because of uncertainty. But whether it gets to that 10% rate or so by the end of the year, I think that's really up to the US president.
Yeah,
Not
no,
something
no
that we
doubt.
can do here. So I don't know how to predict the resolution of tariffs. If one is a little bit more optimistic, then we may avoid recession, but we'd certainly see slower growth. But longer term, and I think this is a good point, this moment has really reminded a lot of Canadians of the importance of getting economic policy right. Right? There's a lot of things that we can do to improve productivity, improve growth, improve labor market outcomes, improve the amount of income that's being generated, improve affordability that we really haven't been um, paying a lot of attention to. Let's say certainly federally and to some extent in different provinces as well. And this moment has, I think, changed how Canadians think about policy and has caused us all to put more weight on economic outcomes. And that will mean, I hope it means, longer term economic benefits through faster productivity growth, which has been lagging for many years. And that means faster real income growth for most Canadians. And that's been lagging for many years. So longer term, I do come down on the very optimistic side of things.
Right. I think, maybe perhaps this is well, it definitely is an eye-opening uh, situation that we find ourselves in. Trevor Tombe, professor of economics at the University of Calgary's Department of Economics and director of fiscal and economic policy. Thank you so much for being on our show and shedding some light into the trade barriers, the coming down of trade barriers. Hopefully, we see that in the coming weeks ahead, and shedding some light on economics and how everything is being impacted with regards to tariffs and what we can do to mitigate the effects on some of these tariffs. Thank you again for joining us, and perhaps we'll have you back somewhere down the road, and or maybe a different environment by then.
Well, sounds good. It was a real pleasure and look forward to next time.
All right. Thank you so much. Great interview with Trevor Tombe, shedding some light on our economy, He spoke about a lot of things there, bringing down interprovincial barriers and what we could do within our own borders here in Canada. Hopefully, the federal government, whoever is going to be the new leader of our government, whether it's uh, Prime Minister Carney will stay in power, whether it's Mr. Polyev, whoever will be the next leader of our country. Hopefully, they can look to within our own country, within our own borders, to improve our situation. I think that's where things start first, and then we can progress with our neighbors after that. Now we come to the part of the show where I talk about three things that I think are important before you make your investment decisions that you should be thinking about. First one, tariff talk as we get closer to April 2nd. We know that President Trump has spoken about this April 2nd date as a date where we will all find out what the US is going to do or what they're planning to do with respect to reciprocal tariffs. Will they be putting tariffs on all goods, partial goods, some goods not? And I think what they've said is if a country puts tariffs on the US, they will reciprocate and put tariffs on them. So let's keep an eye on what happens as we get closer to April 2nd. Second point, economic indicators to watch. We've already had or have seen the inflation data for Canada. We're going to get some inflation data out of the US. PCE will be released in the next week or two. And we're also going to get GDP numbers, very important. So I think individual investors need to keep an eye on that as well. The third point and last point for our show today, continue to look for bargains. There are a lot of bargains out there. We know the market has pulled back. As I said, the S&P 500 pulled back 5%. The NASDAQ probably a few percentage points more. But individual stocks, some of the good quality names have pulled back 15, 20% from their highs. And I think these are opportunity for investors to buy these names, to buy these investment ideas when just maybe a month or so ago, they appeared probably a little on the expensive side. Well, when an investment idea falls 15, 20% or more, it starts to look a lot cheaper. And if those, I guess the fundamentals remain intact, if the story remains intact, that's something I think you should consider. So let's talk about our first point, tariff talk, as we get closer to April 2nd. And we can see here our first chart, which we can pull up. And this is an interesting chart. It basically shows us all the different countries with their tariffs. And really the thing to focus on here is not so much the orange versus the red in this chart, but how wide or how large the tariffs are. And you can see here, just by looking, Canada has, in comparison to other countries, very little in the way of tariffs. If you go down the list here, you see South Korea. South Korea has a lot in the way of tariffs on countries. You look on the right-hand side, you can see India, another country. And President Trump has spoken about India, that their tariffs are quite high. And I guess if you scroll down a little bit more, you'll see that Brazil also has some significant tariffs, Vietnam as well. So this is what I guess President Trump has been alluding to, putting tariffs on countries that are tariffing the United States. And if you look at where the US stands, they're at the top of the list on the left side. And you can see their tariffs are even smaller than ours. So it's no wonder that the president wants to put on these reciprocal tariffs. And as he says, even the playing field. And he believes that the United States has been paying for far too long. And in terms of what they do for the rest of the world, whether it's defense spending, whether it's helping NATO, putting money towards NATO, or putting money towards other countries in their defense, whether it's Ukraine or any of the other allies. It's something that the president, I think he just wants to see a fair playing field. At least that's what he says. Our next chart here shows how, as we get closer to the April 2nd date, that what companies are thinking, what Canadian firms are preparing for. These are price increases. Canadian firms are preparing for it. And you can see here that 50% don't plan for price increases, but that means 50% do plan on seeing or issuing price increases. And the other three bars there shows you to what extent: 0 to 9% increase, 10 to 50% increase, 50 to 90, and above 90%, which happens to be the highest. So many businesses are saying they're going to put tariffs 100%. If their prices go up, it's going to be the consumer that has to bear the brunt of these increases. Trevor Toomb actually produced our next chart. It was on X or Twitter recently, and you can see here the price effect of Canada's phasing in or retaliatory tariffs. You can see the parts of the market that the tariffs will hit hardest, whether it's furniture and furnishings, clothing and accessories are at the top of the list, household household goods, textiles, etc. These are what Trevor Toomb, the interview, the professor from Alberta, what he believes will be affected most by retaliatory tariffs and the effects of Canada's phasing in these retaliatory tariffs. So U.S. puts tariffs, Canada retaliates, and this is what he believes or how the effects will play out and where the effects will play out. So as we get closer to the April 2nd date, where we will hear from the president and the administration about tariffs, I think that's something we need to consider if things leak out in advance. Already, our Premier Ford, has said that he has a better idea as to what the U.S. is looking for. He didn't mention exactly the details, but I think going forward, they have more information and they will continue to talk with the U.S. about that. I think they're going to Washington again this week to have further discussions. And it is my belief, actually, that as we get closer to April 2nd, I don't think April 2nd comes soon enough. And as we get closer to April 2nd, I think we're going to get more clarity, more certainty on these tariffs. I think the biggest problem for the markets is the uncertainty. And if we can get some certainty with respect to tariffs, even though they may not be great, the news may not be so good, I think it will provide some a breather for the markets. And I think you could actually see markets perhaps start to rally soon after, once the markets know the rules of the game and what the U.S. is looking for. So definitely something to consider before you make your investment decisions are the chatter, the talk of tariffs as we approach April 2nd. Second point I wanted to get into is the economic data. And as I said, we've already received economic data out of Canada. The CPI data came out, and we saw where we stand. Our first chart shows where we stand right now. CPI was a little hotter, a little warmer than what we thought. We thought it would come in at 2.3%, came in at 2.6%. And when you look at the core CPI, which takes out volatile food and energy, you're looking almost 3% now, 2.9%. So a bit of an eye opener once we started to, or the government started to charge HST once again on the goods here in our country. I think that HST holiday ended mid-February. Prices started to go up, and we're seeing the effects on CPI. Our next chart shows PCE, which is a data point that the Fed uses to measure inflation. And you can see actually it's been going down, which is a great thing to see, in and around 2.5%. CPI in the US is a little bit closer to 3%. So if you wanted to take an average of CPI and PCE in the US, you would say that they're going at around a 2.5 to 3% clip right now. And that's what we're going to hear. We're going to hear PCE data coming out. We're also going to get the latest GDP data out of the US. And our next chart shows how the GDP data has actually fallen off a little bit. And we're hearing from the Atlanta Fed that it could actually be a negative number. They're talking about a negative 2% rate for the first quarter of this year. I'm not so sure that will actually happen. But even if it doesn't happen, if we do see something in the vicinity of, let's say, 1%, then that would still be a very large decline from the last quarter of 2024. So make no mistake, we're seeing GDP predictions fall. We're seeing the expectation is for that to come down. We're seeing expectations for inflation to kind of hold in that 2.5% rate. So keep an eye on the latest data that is released out of the US shortly. Our third and final point to be considering before you make your next investment decisions is this idea of looking for bargains. There are a lot of bargains out there in the markets. We'll talk a little bit later about the bargains in the tech space, but I thought I would show some bargains outside of tech land. We always talk about technology. So let's put up our first chart here. JP Morgan, largest bank in the United States, largest bank in North America. Look at that chart. Wow. That stock has fallen tremendously. This stock was once upon a time a $280 stock. It's up today when I came on the air at 12 noon, but it got down to as low as in the 230s, actually slightly below 230. A pretty big decline, almost 20%. And I think that's a name that you could take a look at, especially on a big dip like this. So definitely on sale. Citibank, another US bank. Let's show that chart. And again, look at that steep decline. Citibank has had a bit of an upturn recently, but it got as high as, well over $80 a share, got below $70 a share. And once again, on a dip, Citibank pays a pretty good dividend, trading under 10 times forward earnings right now. So really cheap. Why did Citibank perhaps fall a little bit more than some of the other banks? Well, it is considered the most international bank in the United States. And with all the tariff talk and tariffs going on, different countries, Citibank stands to perhaps be hurt the most. Next chart here is Caterpillar, large equipment, heavy machinery. That's what they sell. And you can see here, look at the chart on Caterpillar. They're very big, also international name. They sell a lot of equipment international all over the world, infrastructure build. And you can see here, definitely Caterpillar on sale right now. I thought I would show you sort of the US equivalent, United Rentals. Now, United Rentals rents the equipment, the heavy machinery. Caterpillar is more on the sales side. United Rentals mostly in North America. But you can see here, it doesn't really matter. Stock dropped tremendously as well. Again, a pretty good infrastructure play, a pretty good name to take a look at, down by quite a bit, well over 20% from the highs. And our last chart in this segment is one I get asked about a lot. And I think just in the last few days, I've been asked, Allan, what do you think about Tesla? It's fallen. I think it's down like 44% from the highs. And here's our Tesla chart. And what I would say, and what I have said to many, I'm not a buyer. I know Tesla today got an upgrade from a research firm in the US, so the stock is up this morning. But stock still trades at around 80 times forward earnings. Compare that to some of the other names, and even in tech land, which trade in and around 20 times or less. Banks like Citibank, 9 times forward earnings. You can see Tesla is extremely expensive, even after the stock has pulled back. No longer a $1 trillion company. Today, it is well below the $1 trillion mark. So ideas for everybody, when you're looking about making your investment decisions, keep in mind, right? You want to keep in mind all the tariff talk. You want to keep in mind the economic data, and you want to keep in mind and look for really good bargains out there, because as I said, there are a number of investments trading very cheaply now, even though the overall markets are hanging in only down a few percent. There are individual names that are down a lot more and that are of extremely good quality. So the Bank of Canada recently made a quarter point cut, another quarter point cut. It's actually the 7th cut since they started cutting, I believe, last summer, last June. And they raised interest rates 10 times between 2022 and 2023, only now to see us cut 7 times. And the talk is that they will continue to cut, even in the face of higher inflation numbers. As I said, CPI now coming in at 2.6%, core CPI almost or just under 3%. So Bank of Canada will continue to cut. That's what we're hearing. I'm not so sure it's so clear cut, pardon the pun. I think that the Bank of Canada going forward may take a pause at an upcoming meeting, maybe the next meeting. But I think it's still in the cards that the bank, our central bank, will cut perhaps at least 2 more times this year. And again, they're going to have to, or they're going to want to cut to hopefully help this economy. If we see tariffs, as Trevor Toome said in our interview, if tariffs are here to stay and they stay around for a prolonged period of time, Bank of Canada is going to have to cut rates to continue to try and stimulate our economy. Our first chart shows all the cuts in by the Bank of Canada. You can see them there on the far right-hand side. Two of those cuts were 50 basis points, as you will recall. I think if we do cut going forward, it'll probably be a quarter point at a time. But 7 cuts, 7 since last June. Next chart, Bank of Canada key interest rates versus the inflation rate. I think the thing to see here is once upon a time, we used to see a pretty big gap between where the Bank of Canada rate was once upon a time over 4% and the inflation rate, which got down very quickly to 2 to 3%. Today, look at that gap. You're looking at a 2%, 2.6% inflation rate, but the Bank of Canada rate, 2.75. So that tells me there's not a lot of wiggle room. So even though the Bank of Canada may want to cut rates going forward, I think they're going to have to think long and hard how quickly they cut and by how much. As I said, I think it's going to be quarter point. If anything, they may even take a pause. We should see, or that should help the currency, our currency. We'll see what the effects of the currency, the dollar is based on the US currency, hovering now back around 70 cents. Perhaps if we don't cut as quickly, maybe we'll see our currency start to move higher versus the US dollar, which has been falling quite rapidly versus all the currencies around the world as of late with all this tariff talk. So keep in mind, the Bank of Canada probably will continue to cut rates. So that's a good thing to spur on hopeful growth in our economy. But I think it's just going to come much slower. And I think not as big chunks at a time. So quarter point and at a much slower rate going forward. So is the market concerned with inflation or is it concerned with recession in the US? And that's really the number one question a lot of people have been asking. And on days where the fight or the concern is with a recession, market tends to pull down or pull back very sharply. The inflation talk, well, markets don't like that either. But I think for the most part, we can make the argument that even though the expectation for inflation is to move higher because of tariffs, because of potential or possible tariffs, it seems to be hovering in and around that 2.5%, 3% range, and it's been there for quite some time. Whereas we're seeing a number of economic data showing a slowdown in the United States. Our first chart here, first illustration, shows exactly that, another indicator. This is called the Glassdoor Employee Confidence Index, and it just shows you that right now, the employees, they don't, they have a positive view of their employers, but the business outlook is definitely coming down. They're not as confident as they once were. As you can see, a pretty sharp decline in the outlook for business from an employee standpoint. Right now, our next chart shows the consumer sentiment, and it's interesting because it shows it by party line. You can see here when Trump took office the first time that the sentiment wasn't bad. Came down a little bit during the Biden years, and now most recently has come down even more during the recent Trump period. He's only been in power a couple of months, but you could see that sentiment has dropped in again. The sentiment was quite high when he was elected in November of last year. Markets shot up significantly higher, but since then, all this talk about tariffs really has taken down the consumer sentiment. Our next chart here shows, as I indicated a few minutes ago, where we think inflation is going, inflation expectations of the US consumer. You can see how it's trending significantly higher. And again, this is based on potential tariffs and what people think will happen to pricing of goods based on these tariffs that will come into play either April 2nd or the tariffs that are already in place on aluminum and steel from Canada, the tariffs that are in place against Mexico and China, the 25% tariffs right across the board. So consumers right now are a little nervous. And you couple that with some weakening data in the jobs, monthly jobs creation has come down. Our next chart shows that. You can see that there it is, the last number, 150,000, well below what we saw at the end of last year. So the jobs coming down. Our next chart showing the Fed survey. We had a Fed survey done by CNBC, and that shows that they're expecting GDP to fall significantly from 2.5% down to under 1.8% or 1.7%. So again, another indicator about, or another indicator that the market and even the Fed starting to become more concerned with recession versus inflation. And our last chart here, it's probably a pretty good chart, says it all. OECD sees a weaker 2025 growth outlook for the world, and it compares what the December forecast is to what their latest forecast is. And obviously, the gold is the December forecast, the blue is their latest. And you can see how many times or in how many countries that the blue is below the gold, meaning expecting a downturn from what they were predicting at the end of last year. Canada is a big one. You could see that they were predicting much higher growth in Canada, and now they're expecting a lot less. And if you go down to the United States, it's also less, not as much. China, actually, they're expecting China to grow more than what they were predicting at the end of last year. So it's interesting when you talk about recession versus inflation. I think the talk is now turning over more to the recession side than the inflation side. And I think you could see perhaps the Fed maybe consider cutting interest rates a couple of times going forward. I know that's not the base case right now. We're going to see later on today, the Fed has a meeting and they're going to talk about their predictions, their dot plots, as they call them, what they actually believe is their base case going forward. So, in my opinion, I think right now investors are looking at the recession side more than the inflation side of things. So I wanted to separate out the big cap tech names from the earlier talking about bargains, because I think technology is such a large sector of the market, the economy. It's so important that to separate these two, because big cap tech, the Nasdaq as a whole in general, which is where most of these tech stocks trade, has been down, as I said, in correction territory, 13% down from the recent highs, roughly 7-8% down on the year. And there just are so many bargains in tech land. And as a contrarian investor, as you know I am, those of you who watch our shows and those of you who have spoken to me about investing, you know I'm a contrarian. I buy when those are fearful, and when those are excited about the market is when I'm probably most fearful. So just wanted to highlight a few tech names that have really fallen off, that I think if you can handle the volatility and if you can handle the risk involved in owning these tech names, I think you could take a look at. First one, Meta Platforms, formerly called Facebook. Take a look at this chart. Wow, what a drop off. Stock at the highs was $740. Today, under 600, well under $600 a share. So a name like Meta, down 15, 20%. This is a name that I think you could take a look at. They're doing fantastic things. And keep in mind, there are what, 7, 8 billion people in the world today? 3 to 4 billion are on Meta apps every day, every day. And when you consider how many people don't even have internet, perhaps that's a billion or so people. So maybe half the world that has internet connection are on Meta apps every day. Quite a powerful, powerful company. Second company, which I don't highlight too often, because Microsoft for the longest time has traded very expensive. But even Microsoft has seen better days, and Microsoft has tailed off. Once a $460 stock at a high, today well under $400 a share, a name that I think you could take a look at. Our next name, which is a name that I think a lot of you will be familiar with, but a name we don't talk a lot about, Dell Technologies. Most of you know Dell from Dell Computers, selling laptops. But Dell now has moved very much in the AI business, AI servers, infrastructure, data center, AI. It's incorporating AI into PCs. So Dell, very much a big AI play, doing phenomenal. Numbers were great. Unfortunately, the street was hoping for, or investors were hoping for, a better outlook going forward at their last, I guess, earnings broadcast, when they broadcast their earnings We were expecting some better numbers looking going forward, but solid numbers nonetheless. And you can see how much Dell has fallen, and they're trading close to 10 times earnings going forward earnings. NVIDIA just had their conference. NVIDIA had their conference in San Jose. It was, I think, a big hit, talking about things such as driverless cars, robotics. Having a robot come into your house, I think it'd be kind of cool. Having a robot make dinner, do the laundry for you. According to Jensen Huang, the CEO of NVIDIA, it's not too far off. A lot of people are thinking, 10, 20 years. He's talking about in the next few years before robots become a more important part of all of our lives. So you can see NVIDIA, that a bit of a resurgence as of late on the far right, got down lower, but NVIDIA right now is still dominating in the AI space with 90% market share for their chips. So these are some names I just wanted to highlight very quickly. Some names in the tech space that I think have been hit extremely hard. There are a number of other names as well that you can take a look at if you want to do some homework on it. But definitely names that, if you can handle the risk and the volatility that these names bring, I think definitely an opportunity for many investors. Quick hits, three ideas, three things that I've seen in the news recently that I wanted to comment on. Alphabet to buy Wiz cybersecurity firm. We know cybersecurity is becoming more and more a part of everything we do today. We want to protect our computers. We want to protect our systems, our everything. And we want to prevent hackers from getting in and stealing our information. Number two, more countries starting to boycott American goods. We're hearing it all the time. Buy Canadian. We're hearing Europeans buy European goods rather than American goods. And perhaps this is not something that President Trump wanted to see or bargained for. And maybe this is something that comes out of all this, maybe a good thing for Canada, buying Canadian. Gold climbs to over $3,000 an ounce. First time we've all seen it, trading roughly today at around 3,040 last I checked. And it is the first time that we've seen this. So let's get to the first one. Alphabet buys Wiz cyber firm. And we can pull up a chart on Alphabet. The comments Alphabet made, even though they believe, and many believe, I think Alphabet will tell you themselves that they overpaid for this cybersecurity firm, paying $32 billion for it. Well, Google, it's an all-cash deal. Alphabet, Google has a lot of cash on the sidelines, so they can afford it. I don't think it's going to hurt them at all. But they are now adding a cybersecurity piece, a piece to their puzzle. So all the data center, all the AI, all the cloud business, everything that Google is involved in, whether it's driverless cars with their Waymo division, now they're going to have the cybersecurity to protect the information, protect their systems. And I think it just makes sense from the standpoint of any company, let alone a large or a massive company like Alphabet or Google. The second point, or the second idea, is, as I mentioned earlier, countries moving away from buying US. Countries moving away from traveling to the US. I know here in Canada, a lot of people during spring break told me that they're not going to travel to the US. They're going to travel within Canada this year. They're going to buy Canadian. We all know we've taken US alcohol off the shelves at the LCBO, at the stores, and more provinces. It was started here in Ontario by Premier Ford, and now more provinces are following suit. So more and more we're hearing, do not buy American, do not travel to the United States, buy Canadian, buy local. And as I said, perhaps that's not what the President of the United States, President Trump, had bargained for. Last, but definitely not least, our third point is gold. And we have a chart on gold reaching $3,000 an ounce. And you can see here, if you own gold or bought gold stocks, you've made out quite well. And my only comment there is, yes, many of you know me, I'm not a big gold bug. Gold has been going up because there's been a lot of chaos in the world, a lot of uncertainty in the world. And we know investors flock to gold when that is the case. Lately, with the US dollar becoming a little more soft, that also has helped the price of gold surge above $3,000. So three things in the news that I wanted to comment on that perhaps all of you have seen, or many of you have seen, and thought we would end up with a nice bottom left to top right chart on the price of gold. Show's gone a little bit longer than normal. I always like to try and keep it 45, 50 minutes. So I'm try and take one quick question here because I think it's an important question from our audience. And the U.S. markets, I'll put on my glasses actually to see this. The U.S. markets are down more than 5% this year, but the Asian and European markets continue to make gains. Should I move some money or investments from the U.S. to those other markets? And it's a great question. And I'm always about diversifying not only in the US and Canada, diversifying outside of North America. We have a chart right now to show this question. I had it arranged. We got this question from the audience. It was a question from that came in since the last show. So we were prepared with this chart, but it clearly shows how well the other markets, whether it's China, whether it's Europe, how well they're performing. And it's interesting because the US is the one that are putting on these tariffs. You would hope or like to see the US outperform because of what the president is doing. And quite the opposite. President Trump's tariffs are actually having a resurgence on other parts of the world, their stock market, their economies, which was an interesting thing to see. But for me, I love to invest outside of North America, outside of Canada. Canada is such a small market. But to do it and to do it with companies that trade on the New York Stock Exchange is, to me, the better way to go. And there are a lot of foreign companies that trade in Asia or domiciled in Asia and Europe that trade on the New York Stock Exchange. That's the way, in my opinion, to go to buy names that trade over in Tokyo or in Germany or other exchanges. There's a cost to that. These exchanges actually charge a fee for trading directly on their exchanges. So for me, I think you can get enough diversification looking at names within the North American stock markets. And to me, you don't have to go to other foreign exchanges for diversification. So yes, you want to diversify. You want to look at ideas outside of Canada and the U.S., but a lot of those names trade on your New York Exchange, for example, and New York Stock Exchange. And so that's how I would play those types of investment ideas. With that, I want to say thank you once again to our guest, Trevor Tombe, for some great insights. I want to thank all of you for staying with us during the course of our show. And I want to say that we're going to be back, as always, in 2 weeks' time on April the 2nd. Wow, can't believe first quarter will already be over by the time we have our next show. April 2nd at the same time, 12 noon, same place and same time. And look forward to seeing you all again. And until then, happy investing.